All right, so from the notes, the core argument is that American battery technology, ABAT, is set for a near 2x return. This is based on government support, a much healthier balance sheet, and a huge gap between its market cap and the value of its main asset.
Exactly. And that 2x number, going from around $3.50 to a $7 target, that's compelling. But for the kind of sophisticated investors this is aimed at, especially in this sector, the analysis has to be absolutely airtight.
It feels like the whole story here is about ABAT trying to graduate from being, well, a speculative play, which it definitely was in 2024, to something more de-risked and government-backed.
Right.
And the report does a great job setting up that 2x opportunity. It's really clear on the operational fixes, especially cleaning up the balance sheet. I mean, getting rid of long-term debt, boosting cash to over $55 million, that directly tackles the bankruptcy fears that really crushed the stock.
That's laid out perfectly, and it's a strong hook for stability. My main thought, though, is that the persuasive tone and the intense focus on the upside currently overshadow the necessary depth of the risk analysis.
Okay.
And that, I think, limits the report's credibility in the long run.
So, the risk section itself, it mentions the big ones. Their pre-profit, the cash burn, lithium price swings.
It mentions them, but it's very brief. And it's positioned almost like an afterthought, right at the end.
I expect the risk to be woven into the very fabric of the argument, not just stapled on.
Exactly my point. For a high-risk, high-reward thesis, you need a really robust, integrated discussion of those risks to show true analytical rigor.
So, what's the suggestion?
I think instead of isolating the risks, you should integrate them directly into the discussion of the catalysts. Show how the company is proactively managing them, not just listing them.
So it proves the analysis is more robust because it's already considered the counterarguments.
Yes, it shows control.
That's a huge shift for credibility. Instead of saying, here are the risks, you're saying, here's the risk, and here's exactly what management just did to mitigate it.
Let's take that financial inflection point as an example.
The $55 million in cash.
Right, instead of just stating it, you should turn that cash burn risk from this vague concern into a hard number, a quantified, managed metric.
How would that look?
You'd explicitly state the current operating cash burn rate, which, is going to be high for a pre-profit company, and then immediately use that $55 million cash boost to calculate their cash runway.
Okay, so if the burn rate is, say, $8 million a quarter, you're not just saying they have cash, you're showing they have nearly 2 years of runway at their current speed.
Precisely. That quantified runway is the de-risking mechanism. It proves management bought crucial time and addresses that primary fear of near-term dilution.
Right.
And you can do the same thing with the lithium price risk. When you bring up the volatility, you can immediately pivot to that big EPA contract they won near Monterey.
Because it's immediate revenue.
It's immediate revenue that's not tied to the commodity price. It becomes a strategic hedge. Now ABAT has this baseline revenue stream, which makes them less of a pure play on lithium prices.
That framing makes the cash and the EPA contract feel like strategic defenses, not just good news. That really elevates the analysis from just optimism to a detailed argument about actual risk management.
It creates a sense of control. And for investors in these early-stage companies, that's everything.
Let's move to the second point. This one is about the valuation gap and the government support. The report makes a huge deal about the gap. A market cap of, $465 million?
Versus a $2.57 billion net present value for just one project, Tonopah Flats.
Right. So the market is valuing the entire company at less than 20% of one asset. And this links directly to the idea of a government backing, Supercycle Fast 41 status, that $900 million letter of interest from the Exim Bank.
And that valuation gap is the engine of the whole 2X thesis, no question. However, to really justify why that gap should close, the analysis needs a much more explicit framework. It has to show exactly how these government catalysts directly de-risk the massive technical and regulatory challenges of actually getting to that $2.57 billion NPV.
So the market has this huge discount because it just doesn't believe ABAT can, get the stuff out of the ground efficiently. The current connection is more descriptive. It says the government is helping, but not analytically how.
Exactly. The execution risk for a project like Tonopah Flats is just immense. It's just past the pre-feasibility study. My suggestion would be to structure a dedicated section that analytically quantifies the impact of this government support on the timeline and, crucially, on the dilution risk.
You're framing the government as a direct partner in de-risking the NPV.
A direct partner.
Okay, let's break that down. First, the money. That $900 million LOI from Exim. How do you quantify the value of that?
you have to detail how that non-dilutive debt financing completely changes the equity story. I mean, $900 million in non-dilutive funding compared to a market cap under $500 million, that's massive.
Right.
The analysis has to spell out that this removes the primary need for them to go out and raise cash by issuing new stock to fund the Tonopah project.
And that's the mechanism. That's how the stock price can actually close the gap without shareholders getting wiped out by dilution. If they had to raise that $900 million with equity, the 2x return is gone.
It's completely gone. And that's the comparison the analysis needs to make crystal clear. You contrast the value-destroying path, these huge secondary offerings, with the actual value-preserving path they're on, which is this government debt. The market needs to see that choice laid out.
Okay, so that handles the how for the capital. What about the regulatory side? Fast 41 status? How does that translate to shareholder value?
Fast 41 makes Tonopah Flats a transparency priority project. And in mining, permitting delays are the silent killer. They bleed projects dry, they inflate costs, they push back cash flow for years.
So it's about speed?
It's all about speed. You need to emphasize how cutting that red tape and speeding up permitting directly shortens the timeline from where they are now, pre-feasibility, to actual production.
A shorter time to production means that $2.57 billion NPV is realized sooner.
Exactly. And a shorter timeline means the market applies less risk. Investors use a lower discount rate on that NPV estimate. You're reducing regulatory friction, which increases the confidence in that huge number. It's a much, much stronger argument than just saying the government is backing them.
That's a really robust framework. Okay, let's look at the third catalyst, that record EPA contract. The analysis correctly points out that this validates their tech and brings in immediate revenue. It gives a real sense of operational traction.
The traction is vital, but I think this is where the analysis can be truly original. The way it's presented now, it misses a critical opportunity to bolster confidence in the company's core technological superiority.
The tech they need for the long-term extraction and production?
Yes, right now, the EPA contract is presented mainly as a financial win. But the long-term value of ABAT isn't just about cleanups. It's about their ability to economically pull lithium from the Tonopah Flats deposit with their own proprietary methods.
And the report doesn't really connect how the tech validation from a complex cleanup in California translates to confidence in their extraction tech for a huge project in Nevada.
It doesn't. And that's a fair question for an investor to ask. Why does competence in recycling prove competence in raw resource extraction? They're related, but they're not the same thing.
And you have to make that connection explicit.
You do. You have to elevate the discussion of the EPA contract from just a financial win to a technological proof point. Connect the successful execution of this really visible, complex cleanup directly to the sophisticated processing they'll need for large-scale resource extraction. That's the link that justifies the market re-rating them as a potential lithium giant.
So focus on what the cleanup validates, not just that it made money. What's a concrete way to do that?
I'd suggest exploring the specific tech they used in the cleanup. Was it advanced chemical separation, some kind of specialized membrane? Whatever it was, the point is they successfully deployed a proprietary method in a high-stakes, government-watched environment.
Okay.
That proves their engineering and their chemical processing chops are real.
And that proven competence then directly lowers the perceived execution risk for the $2.57 billion NPV at Tonopah Flats, which is this massive project that needs new extraction techniques to work.
Precisely. If the market's biggest fear is that the tech won't work at scale in Nevada, then you show them it already worked in a highly scrutinized, complex operation. Competence means fewer surprises, fewer delays, fewer cost overruns, which, for a resource stock, is the very definition of de-risking.
That's a much fresher angle. It's not just another contract win, it's proof they can handle the complexity their bigger ambitions require.
Exactly. It shows they can operate far beyond what their balance sheet might suggest.
So we have three very clear strategic ways to strengthen this analysis. The potential for the 2x return is definitely there in the fundamentals, but getting the maximum impact means going deeper on risk and execution.
Agreed. It's all about turning a great story into a really disciplined, high-integrity investment thesis.
Okay, to quickly recap the actionable suggestions here for the ABAT analysis. First, integrate the specific risks, cash burn, lithium prices, directly into the discussion of the catalysts. This creates a more balanced and, frankly, more credible argument.
Right, by quantifying things like the cash runway and framing operational wins as specific hedges.
Second, you need to quantify how that non-dilutive government support, like FAST-41 and the Exxon LOI, specifically de-risks the path to realizing that massive $2.57 billion NPV.
Yeah, focusing on the accelerated timelines and the reduced dilution risk, especially compared to how these projects are normally financed.
And third, expand the discussion of that EPA contract. Turn it from just a revenue source into a key technological proof point that validates the core competency they need for their flagship Nevada project.
You're lowering the perceived execution risk that's holding the stock back. These steps, I think, will transform the report from a compelling story into a robust thesis that can really stand up to scrutiny.
This is really strong. We hope this helps you take the analysis to the next level.